Now it's time to develop the model that will relate systematic risk, beta, to required returns. So we call this model the capital asset pricing model. Before we get into details, let's talk a little bit about CAPM, why it's called CAPM, why is it capital asset pricing model? Because it's not that obvious. So first it's talking about capital assets and then pricing, and it's a model. By model, we mean it's a mathematical representation of the way the world, in this case, financial markets, work. So the model may or may not be valid. That's a different question, but it's a statistical or mathematical representation of how things are supposed to work. Okay, what are we exactly talking about? Pricing model. So now this is a little bit confusing, or it's maybe a little bit confusing because this model, that the CAPM, doesn't actually directly price anything. So it's not going to spit out a price, but it's going to spit out, or it's going to give us a very important ingredient that we will then use in pricing, right? It's going to give us the required return based on the riskiness of something. So the model will give us required returns, and we will use those as our discount rates when we are pricing, valuing things. Now, what things? Capital assets specifically. What are capital assets? Capital assets are things, assets that are used in the production of goods and services. So they are being put into productive use, right? So anything that a business owns can be considered capital assets, valuable assets that it uses in its operations. And the reason we call this capital asset pricing model is because we can take those required returns and use those to value, to price these companies. You say in DCF, discounted cash flow valuation, right? When we are valuing an enterprise, when we are finding its enterprise value, we are basically valuing the capital assets, including all the cash, building, factories, equipment that a business owns. Or when a company, a CFO, for example, is doing capital budgeting analysis like NPV analysis or PI or IRR, they are basically valuing these new projects that will use capital assets, right? So this is what this model is intended for. It's a mathematical representation of the world where it gives us required returns based on systematic risk of what we are looking at. And it's those required returns are used to value capital assets, okay, that are used in the production of goods and services like businesses, companies. So that is the idea. All right. So how do we approach this? So we remember this systematic risk-return trade-off we talked about earlier, right? We had, for example, this Sharpe ratio that related risk premiums, so returns above the risk-free rate, to this total risk measure we had before, the sigma, right? Volatility of returns, standard deviation. And then we draw returns versus sigma. We put, for example, we had Microsoft and Tesla, and we start to think about, okay, what can we do? What should an investor do? And basically the main takeaway from that was invest both in Microsoft and Tesla, along with all the other risky assets, take advantage of diversification. They are less than +1 correlation, create this market portfolio that includes all risky assets, and then mix it with a risk-free asset, depending on your risk tolerance, right? That had given us capital market line, market portfolio, tangency portfolio, all that stuff. But since then we realized, right, a lot of what goes into that sigma volatility is actual diversifiable risk. And then we develop this beta measure. So now when we are trying to value or price individual assets, instead of sigma, what we need to focus on is beta, because that measures their risk that we cannot get rid of. Okay, so let's rethink everything we've done a little bit, right? Instead of Sharpe ratio with the sigma in the denominator, let's develop a measure with beta. And then let's think about risk-reward relationship in that context. So this will give us the trainer ratio. So one more thing that we need to know is, or a different way to think about risk-reward is in the numerator we have expected reward. So that what we call the risk premium. So additional return, for example, historical we may have earned, or looking forward, expected return we demand. To hold a risky asset, divided by not sigma this time, but the total systematic risk of the investment we are considering. So once again, bang for the buck, like Sharpe ratio was, but the unit of risk we are interested in is not total risk, much of which is easily diversifiable, but systematic risk that we are exposed to and we cannot get rid of. So we can now put our risky assets, for example, Microsoft and Tesla, in expected return beta space instead of sigma. So we can replace sigma with beta, right? And this is what that will look like. For example, Microsoft's beta, if you go to Yahoo Finance on the summary page, it's around 0.87. This changes a little bit over time. So what does this beta tell us? So this is less than 1. A beta of less than 1 tells us that Microsoft right now, today, not back 20 years ago when it was a much younger company, but today is a pretty safe company, right? As far as the systematic risk goes, right? Not total risk, not total volatility, but as far as systematic risk goes, it's below average. Remember, average, the market beta is 1. So anything less than it is safer than your average company, average stock, or the market overall. So another way to think about this is if the market were to drop, say, 1% on a given day, on average, you would expect Microsoft to go down about 0.87, so less than the market. Okay, so that's what makes it not quite as risky. When the market goes down, it goes down less than the market. Okay, so it's keeps your portfolio up a little bit compared to what all the other stocks are doing. So that's what beta of less than 1 means. Tesla is quite risky. According to Yahoo Finance nowadays, when I'm making this video, is Tesla's beta is a little bit less than 2. So when the market drops 1%, Tesla goes down a whole lot more than Microsoft does. That's what makes it Tesla riskier, even within a diversified portfolio, right? This market risk, we cannot get rid of it because all these stocks, to a different extent, captured by beta, are moving together, right? So now the question is, what should be the expected return, right? That's why we are drawing these reward to risk, systematic risk. And suppose Microsoft's expected return, and these are the numbers we are trying to come up with, but let's just, for the time being, let's say you expect an annual average return of, say, 9% from Microsoft. And of course, there's going to be a huge variation around it because of the volatility. Some years it's going to be, some months, some years going to be much higher, other times much lower. And Tesla, even more so, around 12%, but with a huge variation around it, as we've seen from volatility from earlier. So as what we had seen with Sharpe ratio, where Sharpe ratio was the slope of that line in the return to sigma space that connected our assets with the risk-free, right? So the steeper that slope, the better the reward to variation or volatility relationship. So the slope of that line was the Sharpe ratio. So similarly, now in expected return beta space, the slope of that line that connects the risk-free rate to our assets is the trainer ratio. So the steeper that line, the higher the trainer ratio of the asset we are looking at, right? So the steeper, like the Microsoft's red one, tells us that Microsoft is offering a better reward systematic risk sort of trade-off compared to Tesla. So now, because systematic risk is what matters and what should be priced, meaning that it should dictate investors' required return, we can actually take this idea one step further, okay? That we couldn't do with Sigma, because Sigma overall, that's total risk. There's a lot of stuff, the diversifiable part, that should not dictate required return, but all of Sigma is matter or should matter for required return. So we can take this one step further. So here's the idea. Here's the main premise behind CAPM, capital asset pricing model. If beta is the only risk that matters to investors, so here we are assuming fully diversified portfolio, and therefore all diversifiable risk goes away, systematic risk remains. In equilibrium, right, all risky assets should have the same trainer ratio, right? So should offer the same reward to systematic risk trade-off, all of them. So we would not be able to have that Microsoft with a steeper slope than Tesla that we have seen in the previous slide. So we mean trainer ratio of Microsoft should be the same as trainer ratio of Tesla. Now why? So let's think about this. Let's go back to the return beta sort of space that we had seen and the trainer ratios, the slope of the lines. So what would happen if we had a picture like this where clearly the trainer ratios are not the same, right? Microsoft's trainer ratio is greater. It's offering a better sort of expected return for the given amount of systematic risk compared to Tesla. So the idea is this: in a market, in a competitive market, if we all understood this was a situation and Microsoft was offering a pretty good deal compared to Tesla, what would happen is these investors would be much more interested in buying more of Microsoft, and they would be interested in selling Tesla because Tesla is not giving enough of a reward for the amount of risk it's exposing us to. So we would all buy a lot more Microsoft, which would drive its price up, right? We all value Microsoft more, so we would drive its price up. Microsoft's price going up, everything else the same, means its expected return would have to decline. So we push the price up. It's more and more expensive, meaning it's not going to offer as much of an upside anymore. So its expected return would start to decline, which means the line would start to flatten. For a given amount of beta, so 0.87, it wouldn't offer 9%. As we push its price up, it would offer less. At the same time, we would all be selling Tesla, meaning that we would be driving its price lower, which means it's cheaper and cheaper, meaning that now its reward is increasing, right? So its expected return would start to go up, and the line, the blue line, would start to get steeper and steeper. Until when? So these two lines are now approaching each other until they overlap, which at that point we would step back and say, okay, we're done. Microsoft and Tesla in equilibrium, they're offering the same reward to systematic risk sort of trade-off. They have the same trainer ratio, okay? So what this means is if we write Microsoft and Tesla's trainer ratios, in the numerator we have, for example, expected return of Microsoft minus risk-free rate. That's the reward for the taking on that systematic risk. That's what we call expected risk premium. Right? So the premium we expect for the amount of systematic risk we are taking on divided by Microsoft's beta should be the same as Tesla's trainer ratio. Tesla's expected risk premium divided by Tesla's beta. That's what it means that they have the same trainer ratio. And we do that. The market achieves that through supply and demand. All right. So we're going to say that things are in equilibrium when this is realized. Now, we can say this doesn't just apply to Microsoft and Tesla. This applies to every risky asset, right? So in equilibrium, there's nothing special about Microsoft or Tesla. Every risky asset should have the same trainer ratio because of this supply and demand, right? They have to offer that reward for the amount of risk they're exposed, systematic risk they're exposing investors to. So if every risky asset has the same trainer ratio, it must be that the market, which is a collection of all these risky assets, should also have the same trainer ratio. So the market's trainer ratio is the expected market risk premium, expected market return minus risk-free rate in the numerator, divided by market beta. Now remember, from an earlier video and from the book, market's beta is 1. That follows directly from the formula. Correlation coefficient times sigma divided by sigma m. If you just plug it in, everything, market's beta has to be 1, right? So the denominator of that market's trainer ratio is 1. So we are left with market's trainer ratio is expected market risk premium, just market return, expected market return minus the risk-free rate. So that means the trainer ratio of all risky assets should be exactly equal to the expected market risk premium in equilibrium due to this demand and supply of investors pushing prices to bring everything to line. Okay, so now again, every risky assets, by the way, every risky assets trainer ratio in equilibrium should be the same as the market's trainer ratio, which equals the expected market risk premium. So let's that's what you are seeing. That's the capital asset pricing model. Asset I, its trainer ratio, should be equal to the expected market risk premium. Now, the part we've been interested in, we've been wanting to find, is that expected RI, expected return of asset, risky asset I. That's what we wanted. Think of it as, we call it expected return. CAPM calls it expected return, but think of it as the required return of investors from a risky asset, for example, a stock. Right? So that's what we've been trying to find. So now let's rearrange. Let's leave that alone. Let's leave that E of expected RI, E of RI alone by rearranging. So multiply both sides by beta I and then add risk-free rate to both sides. And we have our capital asset pricing model. The expected return of a stock or a risky asset equals the risk-free rate. So that's your compensation for just making an investment, leaving your money, right? Opportunity cost of parting with your money for a certain amount of time, plus compensation for risk. So the risk premium component. So the risk rate plus a risk premium component. What's the risk premium component according to CAPM? It is going to be the beta of the asset, systematic risk of the asset, times the expected market risk premium. Okay, so that's what capital asset pricing model is. And if you go back to our expect return beta space, where those lines converged because of the supply and demand, and the market reached equilibrium when it was everything fell on the same line, we call that line the security market line. So security market line is the visual representation of the capital asset pricing model, right? The y-axis is the expect return, x-axis is beta. And according to CAPM, if CAPM is valid, all assets in equilibrium should fall exactly on that line. Right, so Microsoft should be on there, the market should be on there exactly where beta is 1, and on the y-axis the expected return is the expected market return. Tesla should be on there, every risky asset should be on there, because if they are not, if they start to deviate, let's say Microsoft for whatever reason starts to go above the line a little bit, right? We call this above the line, over the line will be too high compared to what CAPM says. Expected returns are too high for the amount of given risk. Now, if expected return is too high, that's a great deal. That's exactly the type of stuff you would want to buy. For the amount of risk, it's offering, according to you, maybe your subjective analysis, it's offering very good returns. We call them, this is a good deal, so we call it must be underpriced. Right? At the price that you're able to buy this is a great deal. So you think it should be worth more, but it's not. So it's offering a higher expected return than what should be according to the capital asset pricing model. So in equilibrium, if the market is efficient and competitive, what should happen? We should all jump in to buy that Microsoft. That's a great deal. It's too cheap compared to its fundamentals and what the required return. And then we buy it and buy it and buy it and drive that price higher and higher. By driving price higher, we are reducing the expected return, our upside, until it falls on the line. Similarly, let's say Tesla becomes overpriced, meaning that you don't expect as much of a high upside from buying Tesla. So it's now below the security market line. Its expected return, given its risk, is too low compared to what CAPM says it should be. So then you look at this and say, well, this isn't a good deal. I don't want to hold Tesla in my portfolio anymore because it's not giving me good enough reward for the amount of risk it adds to my portfolio, diversified portfolio. So I'm going to sell it. And if enough of us decides that and we start to sell Tesla, we're going to drive its price lower and it's going to gradually look a better and better and more attractive investment. Its expected return is increasing and its price drops until it falls back on the line. So that's the premise of CAPM. In equilibrium, because of this demand and supply, all assets should have the same trainer ratio, meaning that they should all fall on that security market line. The slope of SML is the market's trainer ratio, which is expected market risk premium, and which is the same as the trainer ratio of all the risky assets. Okay? So that's the idea behind the capital asset pricing model. It's a lot. There's a lot of detail and assumption underlying it, but the model is very elegant and very simple. Think about what it's trying to do. For a given amount of risk, what is the investor's required return? There could be pages and pages of equations for something like that, right? If there would be an equation. And CAPM, according to CAPM, it's actually very simple. Risk-free rate plus risk premium, where the risk premium is beta times the expected market risk premium. Okay, so implementation will be very easy, very simple, very elegant, although the idea is quite complex and include lots of assumptions about financial markets and behavior of investors within financial markets.